The bond market is screaming, and if you're not listening, you're about to enter the most dangerous phase of your financial life. While most Americans were celebrating the holidays, something unprecedented happened in global financial markets, something that should not happen if the Federal Reserve is really in control. U.S. Treasury yields suddenly surged to levels that are supposed to be impossible under normal conditions. In early January 2025, the 10-year Treasury yield surged past 4.80%, reaching its highest level in months, and this is where it becomes truly terrifying. This happened after the Federal Reserve cut interest rates. Think about that for a moment. The Fed is cutting rates to make borrowing cheaper, and the bond market is responding by pushing yields higher anyway. That's not normal. That's not a healthy market. That's a market in open revolt. And the reason is simple. The buyers are disappearing. For the first time in modern financial history, foreign central banks, the backbone buyers of U.S. government debt, are stepping away. China's holdings of U.S. treasuries have collapsed to just $680 billion, the lowest level since 2008, before China stepped in to help stabilize the system during the financial crisis. Just a decade ago, China held $1.3 trillion in U.S. treasuries. That means they've dumped nearly half of their holdings. India has slashed its treasury holdings to below $200 billion, while at the same time accumulating gold at a record pace. Europe, which holds an estimated $8 trillion in US dollar-denominated assets, is now openly discussing contingency plans. Capital controls, forced divestment. If territorial tensions escalate, US dollar exposure is no longer just a financial issue for Europe. It's becoming a political risk. This isn't theory, this isn't speculation. This is published data, official US Treasury Department data, and it's sending a clear message. The largest debt bubble in human history is beginning to crack. Over the next 20 minutes, I'm going to show you exactly what's happening behind the curtain, why the mainstream media is ignoring the most important financial story of our lifetime, and most importantly, what you need to do right now to protect everything you've worked for. It doesn't matter whether you own stocks, bonds, real estate, or just keep cash in a savings account. Everything is about to be repriced, and that repricing will destroy the wealth of those who aren't prepared. The exodus has already begun. The only question left is this: will you see it in time or understand it only after the damage is done? Let's start with the bond market, because the bond market doesn't lie. Politicians lie, the Federal Reserve lies, CNBC lies, but the bond market tells you the truth through price. Right now, the bond market is screaming that something fundamental has broken in the US financial system. The 10-year US Treasury yield recently hit 4.80%, and in some volatile sessions, even went higher. This is a multi-month high, happening even after the Federal Reserve cut interest rates multiple times in late 2024. Let me repeat that because it's critical. The Fed is cutting rates, which should lower yields, yet yields are going up anyway. That's the bond market telling the Fed, we don't care what you say, we don't believe you anymore. We're pricing in risks you're pretending don't exist. Higher yields mean lower bond prices. It's an inverse relationship. When yields rise, the value of existing bonds falls. So if you're holding US Treasury bonds right now, you're watching your wealth evaporate in real time. But here's why this matters beyond just bondholders. Rising yields mean rising borrowing costs for everyone. The US government now spends over $1 trillion per year just on interest payments for the national debt. That's more than the entire defense budget. That's more than Medicare. That's more than Medicaid. $1 trillion just to service old debt. Not to pay it down, just the interest. And that number was calculated when rates were lower. At current yields of 4.5% to 5%, the interest expense is going to explode. We're talking $1.2 trillion to $1.3 trillion, potentially $1.5 trillion annually within the next 12 to 18 months as old low-rate debt matures and gets refinanced at these higher rates. The government isn't the only one getting hit. Mortgage rates track the 10-year Treasury yield. When the 10-year hits 4.8%, mortgage rates jump to 7%, 7.5%, maybe even 8%. At those rates, housing prices have to fall because nobody can afford the payments. A $500,000 house at 3% interest costs about $2,100 per month in principal and interest. At 8% interest, that same house costs $3,770 per month, a 75% increase in monthly payments. Either housing prices collapse or the market freezes completely. Both outcomes are catastrophic for the economy. Corporate borrowing also gets crushed. Companies financing operations and expansion at 4% to 5% are now facing 8% to 10% rates for new debt. Highly leveraged companies or those with lots of debt coming due face a refinancing crisis. They can't afford the new rates. Bankruptcies surge, layoffs follow. This is how rising yields trigger recessions. So why are yields rising when the Fed is cutting rates? Because the demand for US Treasuries is collapsing. And the reason demand is collapsing is simple. The biggest buyers in the world, foreign central banks, have stopped buying and started selling. Let's talk about China first, because China's move is the most dramatic and strategically calculated. China's holdings of US Treasury bonds have dropped from over 1.3 trillion at their peak to just 680 to 760 billion as of late 2025. That's a reduction of over 600 billion, nearly 50% of their holdings in just one decade, and the selling is accelerating. In the last 24 months alone, China has dumped over $200 billion in US Treasuries. They're not just reducing exposure, they're actively exiting. But here's what most analysts miss. China isn't selling treasuries and holding cash. They're converting dollar assets into hard assets, specifically gold. China's official gold reserves have been increasing steadily, but the official numbers are a lie. China reports adding about 225 tons of gold to reserves in 2023, but independent analysts tracking gold flows through Hong Kong, Shanghai, and other channels estimate the real number is closer to 500 to 1,000 tons per year. China is quietly accumulating the largest gold stockpile on Earth, far larger than official statistics admit. Why? Because gold can't be frozen, gold can't be sanctioned, gold doesn't depend on the US financial system, and gold holds value when currencies collapse. China is preparing for a world where the dollar is no longer the reserve currency, and they're preparing by buying the one asset that has held value for 5,000 years. India is following the same playbook. India's US Treasury holdings have dropped below 200 billion, while their gold reserves have surged to record highs. The Reserve Bank of India has been one of the most aggressive central bank buyers of gold in the world, adding hundreds of tons over the past few years. This is a coordinated global shift. Central banks in Russia, Turkey, Poland, Singapore, and dozens of other countries are all doing the same thing, selling dollars, buying gold. In 2023, global central banks added over 1,000 tons of gold to their reserves, the second highest annual total on record. In 2024, the numbers are tracking even higher. This is the great rebalancing. The world is moving out of paper claims on US government solvency and into hard assets that cannot be debased. And now we come to the data point that should be front page news, but somehow isn't. Central banks globally now hold more gold by value than US Treasuries and official reserves. Let me say that again. For the first time since the 1990s, the total value of gold held by central banks worldwide exceeds the total value of US Treasury bonds held in official reserves. This is a symbolic and strategic milestone. It means that central bankers, the people who actually manage money for governments, have collectively decided that gold is a safer store of value than US government debt. They're voting with trillions of dollars, and they're voting against the dollar. But wait, it gets worse. Now let's talk about Europe, because Europe is the nuclear bomb sitting in the middle of this story. European investors, both public institutions like central banks and private investors like pension funds and asset managers, collectively hold an estimated $8 trillion in US dollar denominated assets. That includes $3.6 trillion in US Treasury bonds and another $4+ trillion in US stocks, corporate bonds, and other dollar assets. Europe is the single largest foreign source of capital supporting US financial markets. And right now, European leaders are discussing what happens if Trump actually follows through on his threats to seize Greenland, annex Canada, or take the Panama Canal. The discussions happening in Brussels right now, behind closed doors, are genuinely shocking. European finance ministers and central bank governors are wargaming scenarios where the EU imposes capital controls to prevent further investment in US assets. They're discussing coordinated sell downs of Treasury holdings. They're analyzing what happens if Europe weaponizes its $8 trillion in dollar exposure as retaliation for American aggression against European allies. And here's the thing, this isn't some fringe idea. This is being discussed at the highest levels of European government because European leaders are genuinely afraid that Trump is going to tear apart the transatlantic alliance. And if that happens, Europe's most powerful weapon isn't military, it's financial. Imagine this scenario. Trump moves on Greenland. Denmark, a NATO member, invokes Article 5, claiming an attack by another NATO member. The EU sides with Denmark and against the United States. In retaliation, the European Commission announces that European institutional investors are prohibited from purchasing new US Treasury bonds and are required to reduce existing holdings by 20% over 24 months. That's $720 billion in forced selling from European central banks alone. Add in private investor liquidation, and you're looking at $1.5 to $2 trillion in selling pressure over 2 years. The US Treasury market would collapse. Yields would spike to 8%, 10%, maybe higher. The federal government's interest expense would double. The deficit would explode. The Fed would be forced to step in and buy trillions in bonds just to keep the government funded. And that means money printing on a scale that makes 2020 look like a practice run. But here's the truly terrifying part. The inflation from that money printing wouldn't be spread globally like it was in 2020. Because this time, the rest of the world isn't holding dollars. China's out, India's out, Europe is selling. Oil producers are diversifying into yuan and euros. The dollars that the Fed prints would stay trapped in the United States. All that inflation, all that currency debasement would hit American consumers directly and immediately. Prices would explode, groceries, gas, rent, healthcare, everything would double or triple in price within 18 months. Your paycheck wouldn't keep up, your savings would be worthless. This is Weimar America, and the mechanism is already in place. All it takes is a trigger. Let me show you what's already happening because we don't need to speculate about future scenarios. The data is clear. Foreign holdings of US Treasuries have been declining for months. In the most recent Treasury International Capital reports, foreign investors were net sellers of US government debt. China sold billions. Japan's holdings are stagnant. The Cayman Islands, where Chinese entities park money, has been selling aggressively. Saudi Arabia's holdings are down, Brazil sold, even traditionally stable buyers are reducing exposure, and this is happening while the US government needs to borrow nearly $2 trillion this fiscal year just to cover the deficit. If foreign buyers are selling and domestic buyers are maxed out, who's left? The Federal Reserve, the buyer of last resort, the money printer. And we can already see the Fed's dilemma playing out in real time. The Fed cut interest rates in late 2024, trying to ease financial conditions and support the economy. But Treasury yields went up anyway because the market doesn't care what the Fed wants. The market cares about supply and demand. And right now, the supply of Treasuries is massive because deficits are enormous and demand is collapsing because foreign buyers are walking away. The Fed is losing control of the bond market. And when the Fed loses control of the bond market, it loses control of everything because the bond market sets the price of money. If the Fed can't control interest rates through policy, it has to control them through direct intervention. That means buying bonds, which means printing money, which means inflation. Here's the death spiral. The government borrows money to fund deficits. Foreign buyers refuse to buy at low rates. Yields spike. Interest expense explodes. The deficit gets bigger. The government has to borrow even more. Yields spike higher. The Fed steps in and prints money to buy bonds. Inflation surges. The dollar weakens. Foreign buyers sell even more aggressively, yields spike again, the cycle accelerates. This is a debt trap, and the US is in it right now. The only question is how fast it plays out. Now let's talk about what this means for your personal finances, because this isn't just a macro story. This is about your wealth, your retirement, your ability to survive what's coming. If you hold US stocks, you're exposed to foreign capital flight. US equity markets have been propped up by foreign investment for decades. European, Asian, and Middle Eastern money has been flooding into Apple, Microsoft, Nvidia, Tesla. But if those buyers become sellers, who's buying? American retail investors are already fully invested. Pension funds are fully allocated. If foreign investors liquidate even 10% of their $6+ trillion in US equity holdings, that's $600 billion in selling pressure. Stock prices would collapse 30%, 40%, maybe more. The AI bubble would pop. All those trillion-dollar valuations based on future growth would evaporate when capital becomes scarce and expensive. If you hold long-term bonds, you're getting destroyed right now. Bond prices fall when yields rise. If you bought a 10-year Treasury at a 3% yield 2 years ago, and yields are now 4.8%, your bond has lost 15% to 20% of its value. You're underwater. And if yields keep rising to 6% or 7%, you could lose 30% to 40%. Bonds were supposed to be the safe part of your portfolio. But in a rising rate environment driven by foreign selling, bonds are a trap. If you're holding cash in dollars, you're exposed to currency risk. Debasement, the Fed is going to print, there's no other option. When foreign buyers disappear and the government still needs to borrow $2 trillion a year, the Fed has to step in. And when the Fed prints trillions of new dollars, each existing dollar loses value. Your savings account, your checking account, your money market fund, all of it loses purchasing power. Inflation is a hidden tax and it's about to accelerate. The only assets positioned to survive and potentially thrive in this environment are hard assets that can't be printed and that foreign buyers are rotating into. Gold is the obvious one. Gold is at all-time highs and going higher. Central banks are buying. Wealthy investors are buying. Even retail investors are starting to wake up. Gold doesn't pay interest. Gold doesn't generate cash flow. But gold also can't be debased, can't be frozen, and can't be sanctioned. In a world where trust in government debt is collapsing, gold is the ultimate safe haven. Silver is following the same pattern, with industrial demand adding to investment demand. Commodities and real productive assets like oil, copper, and agricultural land benefit from inflation and currency debasement. Real estate in select markets outside the US or in areas with strong local fundamentals can preserve wealth. And Bitcoin, whatever you think of it, is increasingly being treated by institutional investors as digital gold, a scarce asset that can't be printed by central banks. Here's the simple reality. For 50 years, the world agreed to hold dollars and US debt because the US was stable, powerful, and reliable. That deal is breaking. Trump's erratic foreign policy is destroying trust. China's rise is providing an alternative system. Europe is realizing it can't depend on American protection or American sanity. And the financial markets are repricing everything based on a world where the US is no longer the safe haven. We're not in that world yet. The dollar is still the dominant reserve currency. US Treasuries are still considered risk-free by most investors. But the transition has started, and transitions in reserve currency status are historically violent, chaotic, and devastating for the old power. When Britain lost reserve currency status after World War II, it took less than a decade. The pound collapsed, Britain faced repeated devaluations, inflation, and economic stagnation that lasted for 30 years. The US is now at the beginning of a similar transition. Most Americans don't see it because the media is focused on political theater, while the actual economy is being restructured underneath us. But the data is clear. Foreign central banks are voting with their wallets, and they're voting to exit US dollar assets and move into hard assets that survive currency collapse. China has reduced Treasury holdings by 50%. India is stacking gold. Europe is preparing contingency plans for an $8 trillion divestment. Central banks globally now hold more gold than treasuries. Gold is hitting record highs. Treasury yields are spiking despite Fed rate cuts. And these are not random data points. This is a coordinated global realignment away from the dollar system, and it's accelerating. In early 2026, we're seeing gold break above $2,500 per ounce, with projections for $4,700 within 18 months. We're seeing yields spike to levels that should trigger Fed intervention, but the Fed can't intervene without admitting loss of control. We're seeing foreign treasury holdings at multi-year lows. We're seeing capital flight in real time. So what do? First, understand that dollar-denominated paper assets, stocks, bonds, cash are all at risk. They depend on continued foreign confidence in US stability. That confidence is evaporating. Second, diversify into hard assets immediately. Gold and silver are the most obvious. Physical metal that you hold, not paper ETFs that can be frozen or confiscated. This isn't about speculation. This is about preservation. If the dollar loses 30% to 50% of its purchasing power over the next 5 years, gold will at minimum preserve what you have and likely gain significantly. Third, reduce debt exposure if possible. Rising rates make debt more expensive. If you have variable rate debt, lock in fixed rates now while you still can. Fourth, consider international diversification. Not all your wealth should be in dollar-denominated assets in US-based accounts. Fifth, pay attention to what central banks are doing, not what politicians are saying. The Fed will tell you everything is fine until the moment it collapses. But central banks in China, India, Russia, and even Europe are telling you through their actions that they're preparing for a post-dollar world. This is the most important financial story of our generation, and it's unfolding in real time. The bond market is broken, foreign buyers have left, the Fed is trapped, the government is insolvent, and the only way out is inflation, currency debasement, and the slow death of the dollar's reserve status. It's not going to happen overnight. This is a slow motion collapse that could take 5 to 10 years to fully play out, but it's happening. The data proves it. And if you're not positioned for it, you're going to watch your wealth evaporate in real terms, even as the nominal numbers in your account stay the same or go up. Your 401k might say $500,000, but if that $500,000 can only buy what $200,000 buys today, you've been destroyed. That's the hidden tax of inflation. That's the cost of currency debasement, and that's what's coming. The exodus has started. China's out. India is rotating to gold. Europe is preparing the nuclear option. Gold is breaking records. Yields are spiking. The bond market is screaming, and the Fed is out of options. except the one that destroys the currency. This is the end game for the debt-based dollar system, and you're living through it right now. The only question is whether you're going to see it in time to protect yourself, or whether you're going to be one of the millions of Americans who wake up in 5 years and wonder where all their purchasing power went. Pay attention, diversify, and understand that everything you thought you knew about dollar stability is about to be tested like never before. If this video opened your eyes, smash that subscribe button and turn on notifications. The next video is going to cover the specific assets and strategies to protect your wealth when the dollar loses reserve status. You cannot afford to miss it. Stay safe out there.